Stop scrolling. If you're holding gold, silver, miners, or even just watching the tape today, you just got punched in the mouth and the next punch is already loading. Because what you're seeing isn't a normal pullback, it's not just a red candle, it's a coordinated reset in how the market is pricing fear, cash and leverage, and most people won't realize what actually happened until it's too late. It's Sunday, February 1st, and right now in New York it's 2:01 am. Before anything else, comment what time you're watching this, because I want to see how global this audience really is. Alright, here's the story you're going to hear everywhere. A political shock hits the market, the dollar spikes, yields jump, metals get smoked, stocks wobble, and everyone pretends that's the full explanation. That's the catalyst, not the real reason. And in a second, I'm going to show you the part that most people miss, the mechanical part, because that's the part that decides whether this is a one-day flush or the start of a violent chain reaction that drags the entire complex lower before the next explosive rebound. So let's take the morning board as if we're standing in front of it together, coffee in hand, trying to separate signal from noise. Rates are pushing up. The 10-year is climbing, and it's doing it with the kind of urgency that tells you someone is repricing policy expectations, not just trading a headline. The dollar is firmer, and it's not just a little firmer. It's one of those moves that squeezes anything priced in dollars, metals, crude, even some of the higher beta equities. Meanwhile, the major stock indices are leaning red. You've got that soft, grinding weakness that usually shows up when big money de-risks into cash and short-term bills. Volatility is up too, which matters more than most people realize, because volatility is the tax you pay to play the options game. And when that tax explodes, the game changes. Now, the metals board is the reason you clicked. Gold got hit hard, like the market suddenly remembered it has to breathe. Silver got hit even harder, because silver always overreacts first and asks questions later, and the whole commodity board is messy. Copper down, energy soft, the platinum group metals lurching around, grains slipping. It's the kind of screen where you can feel the liquidity draining out between the numbers. And if you're wondering why I'm not rattling off a perfect set of quotes, it's because the exact numbers aren't the point. The point is the alignment. When you've got rates up, dollar up, volatility up, stocks down, and metals down, that's a classic cash is king snapshot. It's the market demanding payment for risk right now, immediately. In real time. Still, let me paint the board a little clearer. The long end of the curve is creeping higher while the short end refuses to relax. And that combination is nasty because it whispers tight financial conditions without needing a single official statement. The dollar's move is broad enough that it starts squeezing emerging market risk and commodity currencies. And that's when you get pressure spreading like a spill across the floor. On the equity side, you're not seeing a dramatic crash. You're seeing the kind of weakness that kills confidence slowly. The big index down, the tech-heavy index down more, and the fear gauge ticking up like a heartbeat you can't ignore. That matters because when the fear gauge rises, dealers re-hedge, and that hedging can amplify whatever direction price is already moving. Now zoom back into metals. The front-month gold contract is taking the heat, but you will often see the deeper months move a little differently because the curve is reacting to financing, storage, and expectations. That difference, spot versus futures, can widen or compress depending on stress. When people want metal now, the nearby price can lift relative to later months. When people are dumping exposure and nobody wants to carry it, the curve can flip the other way and the nearby gets punished. Silver is even more dramatic because it's a smaller market with a bigger personality. Paper silver can trade like a risk asset for a few hours, then trade like a monetary asset the next day, and then suddenly trade like an industrial input when physical users step in. And that is why you'll sometimes see a day where silver is down hard even though dealer premiums do budge. Two different arenas, two different audiences. You also see this split in the overseas closes. When Asian markets close weaker in one metal and less weak in the other, it can hint at which side of the planet is doing the buying, but don't overread a single close. The important thing is whether that pattern repeats across sessions, and here's the part people forget. A lot of this is happening while liquidity is thinner than usual. Weekends, overnight sessions, holiday-adjacent calendars. These are the moments when a big order can move price more than it should. That doesn't mean it's fake. It means the market is fragile, and fragile markets overreact. So when you see gold down a few $100 and silver lurching, you have to ask a better question than who sold. You have to ask who had to sell and who couldn't step in yet. But here's the first twist. When everything is down together, it's usually not because everything suddenly became bad. It's because something became expensive. Margin, hedging, financing, or the ability to carry risk. Keep that thought because it's the key to the next part. So yes, the headline catalyst is the talk about a more hawkish direction at the central bank. Markets front-run personalities. They do it because it's easier than admitting the truth. The entire system is built on expectations, and expectations are fragile if traders believe policy will lean tighter, even if nothing has changed yet. They rush to reprice the future. Yields move, the dollar moves, and commodities, especially shiny ones, feel the immediate impact because they don't pay you interest. When yields rise, the opportunity cost of holding metal rises. That's the textbook explanation. But textbook explanations are always late. Here's what I think is actually happening underneath the headline. The market is trying to figure out who is forced to sell, who is hedging, and who is about to get trapped. And you can see it in the way the moves spread across assets all at once. When gold falls fast, a lot of people assume everyone decided gold is worthless. That's not how this works. Most of the time, the first wave is positioning. Leveraged traders get clipped. Systematic funds reduce exposure when volatility rises. Options dealers hedge delta and gamma. And suddenly, price starts moving because of mechanics, not because of opinions. That's why I keep saying, a catalyst can explain the spark. It doesn't explain the fire. Now there's a second story floating around that always gets people heated, and it's about the price differences between New York and Shanghai, especially in silver. You'll hear the word tax tossed around like it's a magic explanation. Oh, it's just tax. Oh, it's VAT. Oh, that spread is artificial. Let me slow this down and make it practical. A value-added tax can absolutely influence local pricing, no question. If you're bringing metal into a jurisdiction where a tax applies, that cost has to show up somewhere, either in the price, the premium, or the paperwork. But here's the problem with the way people talk about it. They treat the spread like it's a static math equation. Real markets aren't static. If the spread were purely a straight percentage add-on, you'd expect it to behave like a shadow of the underlying price. Price up, price down, spread down, clean, predictable, and that's not what we see, at least not consistently. Sometimes the spread compresses during a rally, which makes no sense if the spread is only tax math, and sometimes the spread widens during a sell-off, which also makes no sense if the spread is only tax math. Those moments are telling you something else is happening. Local demand, local supply, settlement frictions, credit conditions, and who's willing to warehouse metal. So if you're watching that cross-market gap, don't treat it like a trivia question. Treat it like a thermometer. When the spread widens in a drop, it can be a sign that the paper market is dumping, while the physical market isn't offering metal cheaply at the same speed. It's a sign that the two layers of the market are out of sync, and that matters, because when layers go out of sync, one of them eventually snaps back. The only question is, which one? Now, I'm going to challenge one idea that gets repeated like gospel. The claim that this is just a tax story, and therefore not tradable. I don't buy that. At least not in the simple way it's often presented, because taxes don't explain sudden bursts of tightness. Taxes don't explain a dealer shelf going from in stock to call us overnight. Taxes don't explain why certain forms of silver disappear first, while others sit. What does explain it is the plumbing, and plumbing is where the next piece gets interesting. That doesn't mean the tax disappeared. It means the market is screaming about something bigger, and here's why the just arbitrage it crowd usually gets humbled. In theory, if one venue is higher, you buy the cheap one, sell the expensive one. Ship the metal and lock the spread. In practice, there are rules, time, paperwork, credit lines, and a whole lot of no you can't between theory and reality. Capital controls, import quotas, delivery specifications, and trusted counterparties all matter. Even when you can move metal, it doesn't teleport. It moves through refineries that have schedules and through vault networks that have limits, and in a stressed market, the cost of financing inventory can jump fast. So the spread can persist longer than you think, not because it's free money, but because it's expensive money. This is also why the paper market can look like it's wrong for longer than you expect. Paper settles with accounting, physical settles with trucks, asses, and time. If you're a manufacturer and you need metal for a production run, you don't care that a spreadsheet says it's cheaper somewhere else. You care whether you can get the right form on the right date without risking your whole schedule. So when I watch those cross-market gaps, I'm not trying to win an argument online. I'm trying to read stress. If the gap widens while the screen is bleeding red, that can be a warning sign that the selling is coming from the financial layer, not the real-world layer. And if the gap snaps shut during a rally, that can be a sign that the pipeline is relaxing, even if the narrative says it's tight. Either way, it's a clue, and clues matter more than opinions. Before we go deeper, quick reminder. The description has bonus links, including a premium WhatsApp channel link and a channel membership join link. There if you want the extras without me slowing down the main story. Alright, let's talk about the what is going on right now question, because this is where the crowd usually splits into two groups. Group 1 says, it's over, top is in, sell everything. Group 2 says, this is nothing, buy the dip, easy. Both groups are usually wrong at the exact moment they feel most confident. What we're likely watching is a phase shift, where participation changes because the tools people normally use stop working the way they expect. Think of it like this. Markets don't break when people lose interest. Markets break when people can't participate normally, and there are two different participation problems showing up at the same time, one in gold and one in silver. Gold's issue right now looks like a volatility problem. When the market starts whipping around options, premiums inflate. That means if you're a speculator who normally buys calls to play upside, the entry cost gets punishing. Your break-even moves farther away, and if you're hedging with puts, you can end up paying through the nose for protection. Here's the weird part. When volatility gets extreme, some straightforward option strategies stop behaving. In a clean, intuitive way, your hedge can bleed even when you're right because the pricing inputs are shifting under you. That discourages speculative participation, so you get what I call a soft freeze. People don't hate gold.
They just can't justify the structure they normally use to trade it. Now, silver is a different animal. Silver's issue isn't just volatility, it's the physical pipeline. This is where you have to picture an actual chain. Refineries, fabricators, wholesalers, market makers, dealers, logistics, credit lines, inventory, and the public. When that chain is healthy, price discovery is smooth. When the chain is stressed, weird things happen. Premiums jump, delivery times stretch, and buyers migrate to proxies because that's the only place they can get exposure quickly. And when buyers migrate to proxies, while physical tightens, you can get a dangerous loop. Paper selling pushes spot down, but physical tightness keeps premiums elevated, and the disconnect confuses everyone. That confusion is where the big moves are born. Now, I'm not saying this is guaranteed. I'm saying this is the kind of environment where a $5 move in silver can happen like someone flipped a switch, up or down, because positioning gets thin. And if you think that's exaggeration, remember, silver doesn't need permission to move, just needs liquidity to disappear at the wrong moment. Here's another clue. When you see intraday swings get larger while volume feels lumpy, it often means market makers are stepping back. They don't want inventory risk. They don't want a warehouse exposure into a storm. They widen spreads. And suddenly, the market feels jumpier. That's not a moral judgment. It's survival. So if you're trading, the first rule is don't confuse volatility with opportunity. Volatility can be opportunity, but it can also be a trap disguised as action. Now, you've probably seen a bunch of articles floating around. Silver surge targets, gold debates in Europe, oil reforms in South America, central bank reserve talk. The headlines are loud and they're designed to make you pick a side instantly. Here's what I do instead. I look for what the headlines are ignoring. For example, the oil story. When you see reforms aimed at attracting private investment, that's not just politics. That's a signal that a producer is trying to stabilize output and financing at a time when global capital is picky. Even small changes in royalty structures and tax terms can shift the medium-term supply picture. And if you think that has nothing to do with metals, you're missing the connection. Energy prices influence mining margins, transport costs, and inflation expectations. Everything talks to everything. Now let's zoom into the danger concept people keep hinting at: demand destruction. That phrase gets abused. Demand destruction is supposed to mean people stop buying because price is too high. But there's another version that's more sinister: participation destruction. Participation destruction is when people want exposure, but they can't access it efficiently. Because the mechanics are broken, the spreads are ridiculous, or the hedges don't work. Gold can see participation destruction through the options channel. Silver can see participation destruction through the physical channel. And when both happen at once, you get the kind of tape that makes experienced traders feel uncomfortable. Here's the cliffhanger. That discomfort can precede the next blow-off rally or the next forced liquidation wave.
Oh!
So how do you tell which one is coming? You watch for whether the selling feels like choice or force. Choice selling is orderly. It grinds. It respects levels. It offers bounces. Forced selling is ugly. It gaps. It ignores support. It accelerates into lows. We've got elements of forced selling here. Not everywhere, not constantly, but enough to pay attention. Now I want to talk about something that might surprise you. Why a bunch of major institutions suddenly sound more positive about metals at the same time. When big firms start repeating similar targets and similar narratives, it's tempting to think, oh, they must know something. Sometimes they do. Sometimes it's marketing. Sometimes it's both. The important part isn't that they're bullish. The important part is why they feel safe saying it now. Based on recently published numbers, you can see that flows into certain commodity and precious metal-linked products have been choppy, not smooth. That tells you there's still uncertainty, and uncertainty is the fuel for volatility, not the enemy of it. Here's my skeptical angle. When everyone on the street starts talking about one trade, the easy money has already been made. The trade might still work, but the path gets nastier. Bigger drawdowns, more fake-outs, more emotional exits right before the real move. So if you're listening to bullish calls, don't translate that as up only. Translate it as expect chaos. Now, there's also the idea floating around that gold looks bubbly in the short term. I don't hate that view. Not because gold is done, but because markets can get ahead of themselves. A crowded long can be fragile, even in a long-term bull trend. And when you combine crowded longs with a sudden dollar pop and a yield jump, you get a flush. That flush can be healthy. It can clear leverage. It can reset funding. But it can also break confidence if it turns into a cascade.
So here's the practical, boring but useful approach. If you need money, taking some profit isn't a sin. If you're trying to protect a physical position and you actually understand hedging tools, you can consider structured protection. And if you're buying dips, don't do it like you're catching a falling knife in the dark. Let the market show you where it wants to stabilize. And here comes the next cliffhanger, because in a structurally stressed market, stabilization can last 5 minutes and then vanish. Now let's go back to the silver angle, because this is where the story gets spicy. Silver has two personalities. There's the investment metal narrative, and then there's the industrial reality. If you track recent market updates, you'll notice that industrial demand themes, power infrastructure, electronics, solar and defense-related production, keep coming up in the background. You don't need a single headline to see it. It's embedded in the way physical users behave. They don't chase price for fun. They secure supply because schedules matter. That's why silver tightness can show up even when spot is falling. The paper market is trading risk. The physical market is managing production. So when people say if price is down, demand must be down, that's too simplistic. Sometimes demand is steady and the sell-off is purely financial. Liquidations, currency moves, rebalancing, or risk-off flows. Now, I promised you a clearer explanation of the VAT debate without making it sound like a courtroom drama. Here's my clean version. A tax is real, but it's not the whole movie. The spread is a blend of policy, logistics, credit, and urgency is what changes fastest if buyers in one region are urgently securing metal and sellers in another region are urgently dumping paper. You can get a spread that looks like a riddle. That doesn't mean the tax disappeared. It means the market is screaming about something bigger. Now, what about the calendar? Everyone wants to know what's coming next in terms of data, catalysts, and events. There's a producer price inflation report in the mix. And regardless of whether it's on time or delayed, traders treat it like a landmine because it feeds into rate expectations. If inflation runs hotter than expected, yields can surge again. If it cools faster than expected, you can get a relief rally that rips metals higher because the dollar softens and real rate sees. Here's the truth. In an environment like this, the data is sometimes less important than positioning into the data. If everyone is hedged for one outcome, the opposite outcome can cause a violent unwind. That's why the market can rally on bad news or sell off on good news. It's not about morality, it's about who is trapped. And traps are everywhere right now. Now I want to give you a mental model that helps you not lose your mind during moves like this. Think in layers. Layer 1 is the headline layer, policy talk, personalities, political announcements. Layer 2 is the macro layer. Yields, dollar, liquidity, inflation expectations. Layer 3 is the positioning layer. Leverage, options flows, systematic risk reduction. Layer 4 is the physical layer. Inventories, supply chain, fabrication demand, delivery constraints. When all four layers point the same direction, the move is smooth. When the layers conflict, you get whiplash. Right now the layers are conflicting, and that's why the market feels like it's trying to shake you out. So what do you do with that? You stop looking for certainty, and you start looking for probability. Probability says the first reaction move is not always the final move. Probability says the market often overdoses it, then mean reverts, then chooses a new path. Probability says if volatility stays elevated, the next big candle is going to surprise most people, either up or down. Now let's talk about the big institutions again for a second, because there's an angle here nobody wants to say out loud. When large firms publish shiny targets, it can attract attention, which can attract flows, which can help the trade they already positioned for. That doesn't mean it's a conspiracy. It means incentives exist. So don't let a target number hypnotize you. Instead, focus on what would have to be true for the target to be reached. Currency weakness, lower real rates, continued diversification, steady industrial demand, and continued investor participation. Some of those ingredients are there, some are uncertain, and that uncertainty is why this isn't a straight line. Now I'm going to tease something that's going to matter over the next stretch. Watch the relationship between gold and volatility itself. If gold is falling while volatility is rising, it often means gold is being treated like sell what you can, not buy safety. That's a liquidity event. But if gold starts rising while volatility is still elevated, that's the market telling you fear is switching into hard asset demand. That transition can happen fast. And when it happens, silver usually follows like a slingshot because the market is underpositioned or the physical pipeline forces a scramble. That's the scenario where you wake up and silver is up multiple dollars before breakfast. Now I also want to be honest about something. There's a temptation to think every big move is the move. Sometimes it isn't. Sometimes it's just the market testing who's serious. A flush can be a test. A spike can be a test. A boring consolidation can be a test. And here's the cliffhanger that keeps retention high for a reason. The next test is already scheduled, and most people won't see it because it's not on the economic calendar. It's in the market's internal stress points, funding costs, dealer hedging constraints, and physical delivery windows. From the latest publicly available filings, you can infer that certain participants in these markets have been managing exposure aggressively. You don't need names. You just need to understand the pattern. When risk increases, they tighten up, they reduce inventory, and they protect capital. That changes liquidity for everyone else. So when you're watching price action, you're also watching the behavior of the people who make the market. Now let's go back to something simple and actionable. How should you think about dips right now? I'm not telling you to buy. I'm not telling you to sell. I'm telling you to respect the environment. If you're a long-term holder of physical metal, price drops can be emotionally brutal, but they don't change the existence of the metal in your possession. What they change is your opportunity set. You can add at better prices if you have a plan and patience. If you're a trader, you need to treat this like a storm. Position size matters. More than being right, stops matter, structures matter. If you're using options, consider spreads instead of naked calls and puts, because pure options can get wrecked when volatility is the main variable moving. And if you don't understand the tool you're using, don't use it. There's no shame in staying simple. Now, one more engagement thing, because I actually care about the community side of this. If you're successful, share your success story in the comments so others can stay motivated. Alright, let's talk about what's coming over the weekend and why it matters. We are going to be breaking down the metal market stress in a way that most channels don't. Not with doom, not with hype, with the mechanics, where the pressure is, what it means, and how it could resolve. And for premium members, we also offer members only videos produced by a separate team with more research. Those are only for premium members, and they go deeper, faster, and with more context than we can fit into the public videos. Now, on the bubble angle, here's a thought experiment. Imagine gold rallied hard for months. Everyone starts feeling smart. Then a sudden shift in rate expectations hits and gold drops fast. What happens next? The weak hands sell, the late entrants panic, the leverage gets cleared. If the underlying demand is still there, physical, strategic, portfolio diversification, then after the flush, price can rebuild and attack the highs again. But if the underlying demand was mostly speculative, the flush can turn into a larger reversal. So the question is, which demand dominates? That's where you watch the physical premiums, the delivery chatter, and the way silver behaves relative to gold. Silver outperforming on the rebound is often a tell that physical and industrial demand are still tight. Silver lagging can be a tell that the move was mostly froth. We don't have the full answer yet, but the market is going to show it. And that's why this moment matters. Now I want to address one more piece from the demand destruction conversation because it is easy to misunderstand and make the wrong move. When participation collapses due to mechanics, it can create what looks like demand destruction, but it's really a temporary inability to express demand through normal instruments. When that normal channel reopens, when volatility cools, when spreads tighten, when inventory loosens, you can get demand coming back all at once. That's the snapback move, and if you're not ready for it, you'll watch it happen without you, so don't anchor to today's price as if it's destiny. Anchor to the structure. Now I'm going to give you a quick checklist I use during moments like this. 1. Is the dollar move driven by genuine growth optimism or by fear and liquidation? If it's fear, it can reverse quickly. 2. Are yields rising because inflation expectations are rising or because policy expectations are tightening? The market reacts differently to each. 3. Is the metal sell-off accompanied by physical tightness signals? If yes, that's bullish long-term even if price is ugly short-term. 4. Is volatility rising faster than price is moving? If yes, the options market is under stress and price can whip. 5. Are equities selling in a controlled way or in a panic? If panic hits, everything can get dragged down temporarily, including metals, before the flight to safety rotation starts. Now, here is the second time I am going to say it because it matters and I want it on the record. If you're successful, share your success story in the comments so others can stay motivated. Let's land the plane, but I'm not letting you go without one last cliffhanger. The way this resolves is going to tell us something bigger, whether the market is entering a phase where hard assets regain leadership or whether cash and short-term yields keep dominating. If hard assets regain leadership, the move back up could be sharp, fast, and disrespectful, meaning it won't give you a nice entry. It'll gap and run. If cash and yields keep dominating, metals could chop and bleed longer than people expect. Not because the thesis is dead, but because the market is starving for liquidity and punishing leverage. Either way, this is not the environment for lazy thinking, so here's what I want from you. In the comments, tell me what you think is driving this more: hawkish policy expectations, forced liquidation, or physical market stress. And tell me what time you are watching because I am genuinely curious how many of you are seeing this in real time across the world. Make sure you're subscribed so you don't miss the next update because the next leg up or down usually starts right when everyone convinces themselves it's calming down. One more thing before you go. I know a lot of you are trying to build real, boring wealth in a world that keeps getting louder, so keep it simple. If you're stacking long-term, focus on consistency, not perfect timing. If you're trading, treat every position like it can go against you first because in markets like this, it often does. And if you want the deeper breakdowns without the noise, check those bonus links in the description again. The premium WhatsApp channel link is where updates hit fast, and the channel membership join link is how you unlock the members-only videos from the separate research team. Also, if you've ever wondered what I'm watching when the screen turns into chaos, comment this. Do you think the next big move is a rip higher, or one more flush lower before the rip? I read these, and your answers help shape what we cover next. Hit like if this helped you think clearer, and share it with one friend who's about to make an emotional decision. Calm minds win when markets get irrational every time. And I'll leave you with this. The market doesn't reward the loudest narrative. It rewards the people who understand the plumbing. This is for educational purposes only. I'm sharing how I think through markets, not telling you what to buy or sell. Do your own homework, use risk controls, and if you're ever unsure, talk to a qualified professional before making a financial decision.